And welcome back to the Elevated Trader Podcast. We are going into part 4 of the New Trading for a Living by Alexander Elder. Kristin, how are you doing?
Yes, Tracy. I'm good.
Yeah? Good.
You ready to wrap this book up?
I think we will. I think we were going to do a couple extra episodes on this, or 2 more episodes or 3 more episodes on this to do 2 chapters of an episode, but I think we're going to throw it all into one and just finish it off. This book has been a challenge, I think, for you to get through, wouldn't you say?
Oh, just me, huh?
No,
it has been.
I think it's been more of a challenge for you than it has been for me.
It hasn't been very exciting. It hasn't.
That's
nothing
the
has
word.
really been like grabbed me and we're like, that's not great. Yeah. No.
Yeah, and I think that's because a lot of this information is it's old information for you and I, right? It's really geared towards new traders, and I think it's a great asset for new traders if you want to really dive into just pretty much everything. There's nothing that it specializes in. And
yes, it is good data for newbies for sure.
Yeah, absolutely.
Yes,
good resource.
I would agree.
So we're going to kind of just cover chapter 6 basically through to chapter 11.
Okay, let's do it. I'll jump into 6. How about that?
All right, go ahead. You go for number 6.
6 is about the market indicators, and he does spend quite a bit of time going over market indicators, but he's generalizing it, and he's just basically, the essence of this chapter is about making sure that people understand, look at the entire market more than a specific stock. And we did kind of go over that in a previous episode, the Dow and the NAS and some of the, the SPY, and then look at your stocks and where do they fall into that category. He also says to make sure that whatever tools you decide to use, if you decide to use them, of course, is to be sure that you understand how they work and what exactly they measure. That's really important. And I think both of you and I can agree with that.
There was another thing that he pointed out there, which was to actually use them long enough that you can actually trust them.
Yes, he does say that for sure.
Right?
Mm-hmm.
Because here's a thing that I see with a lot of newer traders, and I've been guilty of this myself even, and that is you come up with some system, you come up with some rules, and then you start trading it, and then you put it into live action, and all of a sudden you start not following the rules. And one of the things, at least I can say for myself, has been because I lacked trust in that system. That's the reason. And because there's no way that I would deliberately sabotage my success unless I didn't trust what it was that I was doing, right? And that's really what it comes down to. So that's my opinion, of course, but I would be, you got to do something long enough that you can actually trust what you're seeing and what you're doing, right?
Well,
so I just wanted to touch base on that.
No, I think that's really, really important. But also, I think this is really interesting that he was mentioning that be careful how old the books are that you're reading. Because typically those indicators that are in that book were for that time in the market. But because the market is just changes so much, to just be wary of make sure you think about that before you start even deciding to learn about those indicators.
Yeah, well, and there's some things that are, if they're mechanical by nature, then yes, they most likely will have changed because the systems have changed. But if they're theoretical, if it's like concept idea, that kind of thing, some of those things are priceless and they're ageless. They were true then and they're true now because they exist. They're axioms within the way economics work. So, yeah.
Yep, for sure. So that's kind of the gist of part 6 in this book. And one of the things he wraps up with is something that I know I've learned from some of my trading mentors is when people are just so jumping in on this and jumping in on that, or everybody's calling the bottom, to just be very wary that the more people that are talking about it, people that don't trade, maybe your uncle's talking about it or your neighbor's talking about it, and these people don't trade at all, to be very concerned that typically they're calling the top, and you may just want to, and I saw that, and we saw that happen.
Mm-hmm.
I mean, when neighbors were or patients are did you see Apple or something like that? And all of a sudden it's whoosh.
Yeah, it'll look at crypto. That's what happens regularly in crypto. Every single time it starts hitting the news is crypto's the buy. That's usually the top.
And now we got crickets.
Yeah,
And now we
exactly.
got crickets.
Yeah, and it's a consistent pattern, so you can see it in just about everything. When everyone is getting excited about it, that's usually the time when you should probably be getting out. So, yeah, no, good observation. All right, so chapter 7 goes into trading systems, and I think it's really important. I like that he touched on some of this, but some of the things that I'm really glad that he mentioned was he talked about mechanical traders and he talked about discretionary traders. Now, I am a discretionary trader, and really what the difference between that is a mechanical trader adheres to very strict rules. Get in, get out. Like, it's very systematic, mechanical. I'd almost say that it would be attuned to algo trading. You can program a computer to do it for you. You don't need to actually do it. And that is what a mechanical trader is. A discretionary trader allows for personal judgment, allows for more personal judgment. And of course, there isn't just a black or white. There's a scale. You know, there's a sliding scale. Some have more discretion than others, but either discretionary or mechanical traders, both of them have some sort of system in place. They still know what they're looking for to get into a trade. They know what they're looking for to stay in a trade, and they know what they're looking for to get out of a trade. And I thought that was really good. And there's some pros and cons to both the mechanical system and the discretionary type of trading. Mechanical systems, for example, they eventually stop working. And that's very typical. So a professional trader will keep an eye on those mechanical systems all the time. They will be watching them very keenly for any signs of not working anymore. And the minute they stop not working, they need to switch it out with another tool or another system. And they're usually working on a new one that they can put into place, et cetera. So there's always a mechanical system that's going to get replaced and continue to replace those mechanical systems. They will stop working eventually. And the biggest downside to the discretionary trading is that your mindset is very, very, very important. It is probably the biggest aspect that can affect your trading. Is stress can affect your judgments. And so keeping that clear head and that mindset is really, really important. And I think that's why I noticed a huge difference when I made a shift in how I was getting ready in the morning, from spending all this time, you know, looking at the charts and marking all my levels and doing a lot of analysis to mindset. When I switched that morning routine, I guess you could say, to focus more on my mindset and making sure my mindset was, but that's when I noticed a huge change in the success of my trading. But that's because I'm a discretionary trader. So that mindset is really key on my decision making. And if it's not right, it doesn't matter how good you are. It doesn't matter how successful your system is. You'll self-sabotage it. You'll blow it because you'll micromanage, etc. So I really like that he touched on that aspect of it. And cool. The other thing is the market. He says the market is not a mechanical entity that follows the laws of physics. It is a huge crowd of people acting in accordance with imperfect laws of mass psychology. So there's a lot of really good quotes in here that he said, you know, mechanical methods can help, but trading decisions must take psychology into account. And that is so true because there's a crowd, individuals, not all of them are mechanical traders. Not all of them know anything about the market. Not all of them have the same perspective or the outlook. There's a bunch of different factors that play into the market. So that's why I prefer the discretionary type of trading as well versus the mechanical trading. It seems to me it makes more sense. And actually, I'm going to say something too, because it's been in the last couple weeks that this epiphany really got to me. And one of the reasons that I don't like certain indicators, or why I don't like trading with indicators, is because I have spent so much time practicing my discretionary trading and understanding what the market is doing based on certain volume and profile, I guess, signals, you could say, or the way the market is expressing itself or explaining itself, the way that it's presented to me, the way I'm understanding it, that the indicators, because most of them lag, that by the time the signal comes up on the indicator, there's there's a disconnect with what my feeling is, with what my sense or my understanding or my intuition is saying about trading versus what this indicator is saying. So there's this conflict, and it becomes a battle. And then that's where I start to get really, I'll get scared, or the fear comes in, or I distrust what I'm doing. That's if I'm using one of those indicators and not just following the way that I normally would trade versus trying to trade with an indicator. Does that make sense?
Oh, absolutely.
Yeah. That's been an epiphany. I couldn't put my finger on why indicators didn't work for me for the longest time, but that's the reason they don't. I just realized that in the last 3 months. So.
Wow.
Yeah.
Cool.
Yeah.
I like that.
Good insight.
You got anything else on that one?
No, because he goes into the triple screen trading system. He goes into the impulse system, the channel trading system. So it's nice. He actually describes some systems, what they take, and what parameters there are. So if there's a system out there that you're interested in looking at, I think this is a great place that you could start. You can look at them. You can see if they work still and if they work for you, but
test them out.
Exactly. But not only test them out, I guess one of the reasons that I wanted to bring up what I just brought up was because I think it's really key to be self-aware and know who you are, right? And I think we've talked about this in another episode before where we've talked about scalping or anything like that, but it takes a certain personality type to be able to hold a trade all day. It takes a certain personality trait to be able to day trade. It takes a certain personality to scalp. It takes a certain personality to be a long-term investor. It takes a certain personality to be a swing trader. Yep. There's different aspects of those that of your personality that can make it more successful or not. And having that self-awareness and knowing the type of person that you are can really play into the success of these systems. So not only do you want to understand it, you have to be able to repeat the process. You have to be able to see it, and it may not be something that you can see. So I think it's a great starting point. Make sure that it fits with who you are. And if you're at any point feeling uncomfortable or noticing that you're not following the rules, then maybe it's because that system isn't falling in line with who you are as a person, as a trader. And you might want to revisit that. The other thing is these trading systems that are outlined in here, they're starting places. There's no reason that they can't give you ideas that you could research and create your own system and rules around that system and go with that. So it's a great starting point. Like I said, adapt it, use it, trade it, trust it, practice it, whatever. All those little good things.
There you go.
Yep. So then that's about it for part 7. So what about part 8?
Okay, so part 8 is about trading vehicles. So he's talking about stocks versus ETFs versus options versus futures and things of that sort. Things that are illegal in the United States, which I believe is that CFD thing. He also talks about how it's really really popular outside of the U.S. to trade currencies. And then he just points out a couple things that whatever you decide to trade, make sure that you have 2 essential criteria, which is liquidity and volatility. And oh my gosh, that's so true. Without volatility, you're just chopping around, right? I mean, you and I've seen that. We've been butchered by that. And then liquidity, you just can't get in or out. Like you could get partial fills and things like that. So that's definitely something to pay attention to. Let's see here. What did you get out of it?
Again, I think that's a really good opportunity. If you want to learn what each of the different instruments are, what the opportunities are for you out there in trading, then that's the chapter to go to. Yeah. Take a look at it and see what kind of interests you. And if there's something that you want to venture into, then, get an idea what it is here and then go for it, right? Check it out.
Go for it.
Yeah, absolutely.
So I bet you had a lot in the next part.
Yeah. So part 9 is risk management. And I think that risk management, this is a key chapter. Do not skip it because not a lot of people talk about risk management. And I think that's the biggest mistake. As far as I am concerned, you cannot be a trader without having risk management. If you don't have risk management, then you're just a gambler. That is the difference between a gambler and a trader. So Yeah, you heard it here. Well, I probably heard it from someone else.
Yeah,
which
like
is why
where'd you
I
learn
said
it?
Yeah.
You didn't learn it from this book.
Yeah.
I was
but
waiting
risk
for you to
management-
get up on this soapbox, by the way.
So he did say everyone has a plan till they get punched in the mouth. This is why risk control must be an essential part of every trading system. And it is so true. I don't care how much your intentions are to exit when the price gets down there. The minute it does, your emotions kick in and you are not able to pull the trigger. And that is just human nature. Human nature does not like to be wrong. You do not like to lose money. You do not like to see things not work in your favor, all of those different things. So there's always going to be that little glimmer of hope that says it'll turn around if I just wait a little bit longer.
But a computer doesn't think that way. An
That's
algo
right.
doesn't think that way.
That's right. So you have to have a plan. Having a plan is the best way. I mean, we talk about this with our kids all the time. Have a plan. Don't wait until you're actually in the environment to get yourself into trouble. Plan ahead of time. So
True
preparation. And I don't care if you're building a house, plan ahead. You don't just start building a house. You run into trouble. So focus on managing your trade and the money will follow almost as an afterthought. I thought that was a really key part of the book as well. Focus on managing your trade. Don't focus on making money. Focus on managing your trade. That was a big takeaway for me.
Okay, like it.
Yeah. All right. So the next part was part number 10, which was practical details. Now, this is like setting targets, profit targets, how to set a profit target. And he goes into a bunch of different scenarios of how to do that. And I mean, choosing your exit strategy is just as important as choosing your entry strategy. So having that is all part of your plan. And whether you take partials, which means you exit a little bit at a time, or whether you exit everything at a specific point, or whether you trail yourself out. So you wait for the price to actually come back far enough that it hits your stop. And whatever that is, have that system and know the exit. I don't know how many times I've seen a trader, they get into a trade and then they don't know what to do next. And that is part of the planning process. That is no different than not knowing how to enter a trade. So as far as I'm concerned, it's a very key element. So right up there with risk management. What about you?
No, it's funny because in the beginning of his trading career, he didn't think of like profit targets. And he said, well, if people asked him about it, he answered that he didn't want to set a limit on his profits, his profit potential. But then he realized like, that's not the best way to go. There's that term that people use called stacking wood. So it's kind of like twofold. Again, you're like win, small win, small win, small win. But in the end of the month, you've had a great month. So I think that's one of the things that I had to wrap my head around was like, number one, follow my rules, good trade. Number two, was it the biggest target and that it hit what I want to make every day? No. But at the end of the week, you know, do I have to hit singles and doubles and triples and home runs? You know, I come from a big softball background. I mean, my mother put me in T-ball at 6. Okay. But so I could really appreciate, and it wasn't this book, it was another book. It's like, okay, like you can hit just a bunch of singles. You know, if everybody on the team went hitting just singles, you're still scoring. So just perspective, I guess.
Absolutely. And actually, so the last 2 chapters, like the chapter 10 and chapter 11, I got the most out of the entire book. Yeah. And one of the things that I thought was really cool, because he says, before you put it on a trade, start planning at what level you'll begin protecting your profits. Now, I have extra strategies that I use all the time, but I never really defined a level that I actually want to protect my profits on, which I think is something that I might start thinking a little bit more. So once it gets above a certain level, I'm going to start protecting my profits and I'm not going to let it retrace. I think that's going to apply more for my swing trades than it will my day trades. But I thought that was something that it stuck with me anyway. But
I love protecting my profits.
Of course. I
love taking partials because then you're locking some in.
Absolutely. And that's more how I protect my profits on day trades is I lock in money as I lock in partials. So, but the 2 things that I did take away from here was in the last 2 chapters, he grades his entries and exits, and he grades his emotions. So
Okay.
that I thought was really, really cool. And he goes through some scenarios of how he creates those grading systems. And I've actually taken the system that he designed for your mood, and I've put it into my spreadsheet. So I just I go through some questions like, what am I feeling today? Am I feeling ill? Am I feeling good? Am I feeling really great?
Like emotional stability before trading or after trading.
There's that. So I select the answer. It gives me a score. And then I go through the next question. It gives me a score. Next question gives me a score. And after I've answered all 5 questions, I get a total score. And then I have it programmed in my spreadsheet that it'll come up and either if it says red, if it's red and it says no trade, that means that I should not be trading. I'm emotionally compromised for whatever reason, or I'm not prepared enough, whatever that might be. There's something lacking that is putting me at risk to trading today. So no go. So I'm only allowed to trade if I'm in the yellow or the green, preferably just the green. The yellow, I need to be aware. But again, we've talked about this before. This just brings things to the surface so that you're aware of where you're at. So that's pretty cool. The next thing that I'm working on right now is actually setting up a grade to evaluate my entries and my exits.
Okay.
Because he goes into this and talks about, that thing with early adopters, laggards, and what have you. There's that scale of adoption. Okay. Traders are the same way.
Okay.
All right. You get early adopters, which apparently I am. And then you get laggards, which are the ones that are looking for all that confirmation. Okay. Another key point. If you recognize the type of person you are, that's also going to help you in your trade. I know that I'm an early adopter, which means I'm generally in the trade early before it actually starts to move. Given that, I need to be more patient. And I haven't been being more patient. And because of that, I'm over managing my trade sometimes and getting managed out of my trade. And then it starts to work. Yeah. That's something that I've had to change because I recognize that I'm a early adopter. I see things as it's building, I get in, but it hasn't really moved yet. So one of the things that you can do when you're grading your entries and exits is you're determining where exactly are you getting in, where exactly are you getting out. And if you're getting in a lot of losses and you're in a certain range, then maybe you're taking trades that are more laggard trades or taking trades that are early adopter trades, whatever it might be. But you can start to...
If you're on a 1 minute chart, I'm sorry, but you really just fit into one category.
Well, it's really about the location for me. And I think that that's key, but it's a great tool. It's just one more thing that you can use to become better aware of who you are as a trader and how you can improve. And if you find out that all of your trades you're getting into late because you're a laggard, then you need to make some changes, right? There needs to be something else that you need to understand because you're getting in after the fact. You're getting in when everybody else is getting out. And that's an issue. So I think that that's a really key component that I'm going to be adding to my trade analysis every single day is my grading system for my entries and my exits. So I thought that was really key. Those were my biggest takeaways that made me the most excited about this book. So.
I would have to agree with you because that self-analysis, however we can upgrade our self-analysis to become better traders, hands down is more important probably than all that other stuff. So he wraps it up with a lot of mindset and things like that. So I like that
Absolutely.
a lot.
Yeah, it was good. So, all right, folks, happy New Year, and we will see you in the next episode.